Hello, I'm Kim Stafford, and I'm here again with PIMCO Group CIO Dan Ivison to give you an inside look at some of the recent discussions taking place within PIMCO's Investment Committee, or IC. Thank you for joining us, Dan.
Thanks, Kim.
We've been talking about for a while value returning to bond markets, and we've actually seen that come to fruition in absolute and relative performance. How should investors think about bonds on a go-forward basis?
They should be happier than they've been over a good portion of the last few years. Not only have we achieved attractive yields this year, we've finally seen some total return or price performance as well. But I think an investor looking at a 3 to 5 year time horizon, looking at current yields within the higher quality areas of the bond market, still should be quite excited about the return potential in an absolute sense, as well as potential returns versus risky areas of the financial markets like equities. So, we have had a significant rally. We've also had a big shift in positioning across yield curves, and this has been very, very attractive from an active management perspective. There's a lot going on all around the world, but there's also been tremendous divergence around high-quality bond markets. Some central banks have already cut rates. Other central banks are dealing with inflation challenges like Japan. It's creating divergence. It's creating fundamental overshooting in markets, technical unwinds. The name of the game, in many respects, is to take advantage of this overshooting, have a longer-term horizon, and be able to use all the tools at our disposal to generate value for the end investor.
In addition, obviously, we've got the U.S. Fed poised to cut rates. The pace and the magnitude of those rate cuts is a little bit uncertain given some of the slowing economic data and labor market data. How should investors think about this? How are you thinking about that in terms of active management?
Yeah, well, we see signs of the economy slowing. The inflation data has been more constructive over the last few months, certainly relative to where we were earlier in the year. And we do think with a high probability the Fed's going to begin to cut rates in September. We also think there's a decent chance that there are further rate cuts going into year end. They're going to be very data dependent. Some of the data has been weak recently. Some of the data is a reminder that we're not in a recession yet, and the economy still has a decent amount of momentum. So this has been a great environment to make active investment decisions. Having a global perspective has been quite rewarding, and we expect that to continue to be the case. So it's fun again, fun for bonds to be generating positive returns, but also fun in my seat. And I think I can speak for the whole team in terms of confidence in the ability to generate attractive risk-adjusted returns for many quarters to come.
Mm-hmm. So in terms of investment implications, obviously potential rate cuts, increased volatility. Can you specifically talk about the role of duration in portfolios for investors?
Yeah, so I think this was an example, again, over the last several weeks where duration served its role as being a diversifier across a multi-asset portfolio. Put more simply, when stocks went down a lot, bond prices went up. Today, our fixed income valuations are much more attractive, both in relative terms and absolute terms. So we think not only will bonds provide attractive returns in the base case, they should begin to exhibit those diversifying qualities that have really strengthened the case for them to be in an investor's portfolio. And as a reminder, cash does not provide that type of diversification. What you can do by taking on a little bit of duration exposure is lock in these very, very high rates of return for many, many years to come. We're not talking about taking massive duration risk across portfolios. We still think it makes sense to have your maturities in the intermediate portion of the yield curve. We think that after the rally that we've seen more recently, that tactically you could bring your duration into a more defensive position.
And to that point, investors should act now or wait until the rate cuts come to fruition?
I think, there are some people, out there saying that total return in fixed income was dead. The last few months were a reminder that that's very far from being the case. These rallies could happen in an unpredictable fashion. And if you wait, you're at risk of the cash rate dropping and you not being able to lock in those returns.
And you obviously mentioned divergence. That was a theme that came up and was a conclusion of ours that we predicted in our cyclical outlook back in April. We're seeing it come to fruition. It's creating volatility and opportunities. What global investment opportunities are emerging today that you want to talk about?
Yeah, the first will be just high quality opportunities. When you look at the world today, there are a lot of countries that have more fragile economies. Economies where the household sector is much more sensitive to these higher policy rates. They also have yields that in some cases are actually higher than the United States, and they have governments that are close to balancing their budget. which is always nice from a fixed income perspective. So countries like Australia, New Zealand, the United Kingdom, Canada, higher quality emerging markets that have underperformed more recently are all very attractive diversifiers versus the United States. All of those generally are high quality bond markets. We haven't necessarily gotten quite enough widening in the more economically sensitive credit sectors yet, but even there we're beginning to see more overall volatility. So our general themes now are to remain nimble, remain liquid, be up in quality, stay diversified, use a full global opportunity set, and then sit back and wait for the type of volatility that we've seen more recently to be much more tactical and targeted in your allocation to some of the riskier segments of the market.
Great. Thank you very much, Dan. And thanks to all of you for joining us. We'll see you next time.